Great. So I guess we'll just start off on time. Thanks, Amit. I'll take it ahead from here. Yeah, good evening, everyone. I think I'd like to extend the warm welcome to all of our esteemed clients and distributors here joining us today on this webinar hosted by Emkay Investment Managers. I would say I'm truly delighted to have all of you with us today. And as we dive into some insightful and thought provoking discussions that will absolutely help us to navigate the current dynamic world of equity investments and specifically how the market has been in the last few months. Allow me to introduce myself. I'm Rahul Sejwal. I have the privilege to be leading the West Zone for MK Investment Managers here. It's an honor to host this session. I'm looking forward to engaging with all of you on this particular platform. Now, I'm sure many of you are here for the valuable insights from Sachin. So let me just introduce Sachin as well. Sachin Shah has been a seasoned fund manager with over 2.5 years of decades of experience into this equity markets. His extensive research and experience led him to realize the need for a structured framework to identify and evaluate companies, especially those with tricky governance standing, right? This led to the creation of the Equal model, which is one of our proprietary models developed by MK, more so by Sachin, which is used to evaluate and compare listed companies based on multiple aspects of governance. So Sachin's profound knowledge and unique insights were widely sought after, and he often shares his expertise through various media interactions across print and digital platforms. We are fortunate here to have Sachin as a part of our MK team, and I'm sure you will find his presentation highly interactful, highly insightful, and valuable. Before just handing over to Sachin, just to set the agenda, we would be covering, first of all, the broader markets, more of a market outlook currently. Then a short insight on the equal philosophy that I just spoke about. Then would be followed by the update on Capital Builder portfolio itself, how it has been able to perform and the consistency of the performance. And the same would be followed by the Q&A session, and which I'll take for going ahead. Without further ado, I think let's welcome and joining Mr. Sachin Shah. Sachin, over to you.
Thank you, Rahul. Thank you so much for this generous introduction. And thank you, friends. Very good evening to all of you. Thank you for giving your time on a Friday evening. And that too after a very roller coaster market 1 week that we've had. I think this has been one of the most brutal weeks in the recent times. I believe the mid cap and the small caps are probably down in the range of whatever 8 to 10%. At an index level, I'm sure stocks will be down even more. Large caps are down about 3%. So these are definitely relatively tougher times compared to what we've seen over the last probably 2 3 years. And that's probably the reason why we just thought that it's time that we, you know, get in touch with our investors, our existing investors, our prospective investors, and share with them what are our thoughts. So I'll start by talking about the current environment and where are we headed. So Rahul, is my slide number 2 visible? The fiscal deficit.
Yes, it's
Okay,
there.
great. Thank you. So, guys, starting with the recent topic, which is the budget, I think this has been one of the finest budgets in the last 5 7 years from a capital market perspective. Of course, it starts with, if you see the fiscal discipline that the government has been adhering to and is committed to, I would say. And this plays a very important role. A lot of us might wonder that why fiscal deficit is so important. But it is very critical because it tells us that government has enough amount of earning power. Government is spending in the right direction, and yet there is not too much of deficit, because that will eventually lead to a very controlled inflation. And as we move to a couple of more slides, you will see what I'm talking about, how this government has been fairly disciplined about it. The second thing, obviously, the lower the fiscal deficit, clearly the government debt to the overall government debt also remains under control. and which is also very critical for us. And as you can see, these are some of the numbers that we've seen shown here, and not only India, absolutely, but even compared to a lot of other countries, I think we are in a much better position today as far as our government debt to the overall GDP is concerned. I think all of this is what I was talking about, that a controlled fiscal deficit, a lower government debt, or a very controlled government debt to GDP, attracts a lot of foreign investors. And I'm sure today, top of the mind is the way foreign investors are selling in Indian equity markets. What is going to happen here on? Are they really going away for good, or will they come back? So, these are some of the data points. I'm just trying to set the context for what we are going to discuss as we move ahead. So, this is something what we have to understand, that in the last, year or so, thanks to the fiscal deficit, thanks to the inflation, thanks to our currency, thanks to the government debt to GDP, today India, at least for the bond markets, I think for the first time we are seeing that FPO, foreign portfolio investors, are looking at investing in government bonds. Equity has always been, FIs have been investors in Indian equities for decades now, but investing in government bonds is I would say a relatively new phenomena, and it's coming with a very solid foundation, because now we are getting included in quite a few global bond indices. So this is something which is very unique and very good for India, I would say. Uh, I think the other very interesting thing about the budget has been about the, if you see the last few years, particularly from a capital market perspective, I think there has been a lot of status quo in terms of no change in capital gains, no change in dividend tax. But other the last few years, we've always had some negative from a capital market perspective, whereas this budget there was nothing negative. In fact, there was a lot of positives in terms of the taxation rate getting much more aligned. Because today, if you think about it, the annual income up to 12 and a half lakh rupees, you don't pay any tax. If you have a double income almost at a household level, 20 to 25 lakh rupees of annual income, you don't pay any tax. And even if you have a higher income, I think an income of an individual at about rupees 20 to 25 lakhs, you just pay a tax rate of about 10 to 12.5%, which means at a double income household level, anywhere an income of about rupees 40 lakhs to 50 lakhs, the effective tax rate today for the new financial year is going to be just in the range of 10 to 12.5%. To my mind, this is a very, very big game changer, because today there are probably 5, 6 crore people which are paying taxes. But with this kind of very reasonable tax rates for an income of as high as 20 to 25 lakhs, or at a household level of 40 between 40 to 50 lakhs, an effective tax rate of just about 12 to 12.5%, will probably take this number to much more than 10 crores in a very short period of less than 5 to 7 years, is what I believe. So from that perspective, I think this can be a game changer. And what we have been discussing about for last so many years, that we need to widen the tax net. More and more people need to pay tax. More and more people need to disclose their full income, not only partial income but full income. I think that's a very high probability that over the next 3, 5, 7 years. So that's another very great foundation that has got established with this budget. I think globally is something that I would also like to share. I think this is an era where first time India is overtaking China as far as the growth rates are concerned, and this is, I think, getting recognized globally with across not only global investors, but also with a lot of large institutions, large corporates, large multinational businesses, because the kind of the business opportunity that Indian markets or the Indian economy offers is probably unparalleled today in the entire landscape. So from that perspective, I think it's very important to appreciate that India is getting into a very good sweet spot. The other very interesting thing is that manufacturing as a space, and this is from CRISIL, and we have been talking about this for more than 2.5, 3 years. But about a year back, even CRISIL came out with this, and where they said that the manufacturing GDP of India will grow much faster than the overall GDP. And as you can see here, that the projections are that we will grow probably at almost 9% plus as far as the manufacturing GDP is concerned over the next 5 years. So that is something which is something, will have a multiplier effect across the segments within the country. And we can already see some early signs of that in the last few years. The capacity utilizations have reached a peak for many industries, and that's why new capex is happening, whether it's auto ancillaries, whether it's auto, whether it is specialty chemicals, pharmaceuticals, engineering, electronics manufacturing. There are quite a few industries where, in fact, even in some of the hardcore industries like cement and steel, I think today the capacity utilizations in the top five players has reached beyond 75-80%. So new capex there is going to happen and is happening, is clearly reflected. I think also the role of government as a catalyst, by way of PLI schemes, by way of giving a lower income tax rate to new manufacturing units since 2019, second half of 2019. I think these are also some of the very key reforms which have not only been very well designed, but also got very, I would say, got reciprocated by the industry, very very in a very with the open arms. I think these are few, for the first time I've seen in the last few years, where a lot of government policies have got not only accepted but embraced by the industry, and that is why huge capexes are happening over there under the PLI scheme. Already 2 lakh plus crore capex has already happened. There's some much more commitments which is happening. So I think this is another very positive thing that's going through. Uh, and of course the reforms which are very very silent in nature at times, but over a few years you realize that these are things which have become game changers. These are very mega trends which are playing out in the economy. So those kind of things, are really helping, whether it's the GST collections, whether it's the e-way bills, whether it's the UPI digital collection. I think UPI has been one of its kind in this world, I would say, in the world landscape. Today, that is something has become the world's case study. Also, Jandan accounts, inclusion of Bharat with India is playing out and has played out beautifully over the last so many years. Uh, but I'm going to be a little slow in the next 2 3 slides, because I think this is something what is a little less appreciated or underappreciated, and I believe this is the foundation for the next 2 3 4 5 years, and this will answer a lot of people's anxiety as far as the foreign flows is concerned. So as you can see here, the inflation has been under very very it has been just sliding down one way as far as India is concerned, uh, over the last 10 years, from nearly double digit to a mid single digit and a very stable inflation. As you can see here, both CPI, core CPI, we are in the range of 4 5%. And for a developing India, for a developing country like India, I think some bit of inflation is always necessary. And probably we are getting into that range of maybe 3 4 5%. We are already there, and I think that should sustain quite a bit. What we've seen an impact of that is that the 10-year treasury yields of US and the 10-year India GSEC bonds have narrowed. And thanks to that, the rupee depreciation has also been very, very reasonable compared to our previous years and compared to the other currencies. And I will just go to the next slide, which elaborates the previous points here. So you can see here that what used to be a nearly 570 bips of differentiation between a 10-year India GSEC and a 10-year US Treasury, I think that has narrowed today to as low as 2.3%. This is absolutely unprecedented. You can see this over the last 10 years, how it has been playing out, and very structurally, this has played out. Of course, this is thanks to the lower inflation, thanks to the lower controlled fiscal deficit, thanks to government debt being under very much under control. So all of this is getting reflected over here, and this spread narrowing is of a huge benefit. And because we have to understand one thing, that this interest rate differentials do have an impact on an annual rupee depreciation. You can see this in the previous, if you take the year 2009, 2014, in those 5 years, rupee depreciation against dollar annually was 6.3% annually. This has slowed down to as low as just about 3 to 3.5% in the last 10 years. In the last 5 to 10 years, it is just from 2014 to 2024, it's just about 3%. Now, this is of a lot of significance, and that is why the we are getting Indian bonds are getting included in the global bond indices. That is why foreigners will be looking at Indian equity markets or Indian capital markets overall with a much constructive view, because their confidence in the currency is today going to be much better compared to what it was a few years back or a decade back, right? And I think even if you see India's performance, India's Indian currency or Indian rupee performance versus some of the other currencies, whether it is among the emerging markets, whether it's Indonesia, whether it is Vietnam, whether it is among the developed markets like Europe or even in the UK pound, you see we were, if you just take the calendar year 24, Indian rupee depreciated by just about 2.7%, whereas many other currencies, in fact, Euro was down 6%, Indonesia was down 4.3%, Brazil was down 21.5%. So these are things which will get reflected when the foreign investors are going to start looking at investing beyond USA. Today, their focus is very much on USA, but that's not going to be the prominent case. It's just a question of quarter or maybe less than that. And they will start looking at other markets where they need to allocate capital. And when that happens, it is these data points which will help or allow India to attract tremendous amount of flow. Even if you look at in the current calendar year, the last 45 days, which has been a lot of a flutter, over there also rupee depreciation, in spite of all the noise, all the headlines. If you just look at the data, it has depreciated by about 1.3%. Again, very resilient compared to a lot of other currencies globally, both in the emerging markets and the developed markets. So I think this is something what I wanted to really focus in today's presentation, that the fear that we have that the foreigners are selling and they will never invest back, I don't think that is something what we should be too much worried about. Our fundamentals as a country are very, very strong. And it's just that as our businesses start, performing, there we will see a lot of foreign flows coming, right? Uh, just to share with you also the actual data points. If you see if you just take from January 24 till February 25, till yesterday or maybe the last week of February 25, uh, say the last 14, nearly 14 months. In this 14 months, I've just divided it into two periods. If you see the first 9 months, which is January 24 to September 24, FIIs were net buyers of almost 2 lakh crore plus. In the last about 4.5 months, which is September 24 till about in the February 25, they have sold practically most of it, which is almost 2,20,000 crores. We all know that this has got initiated because after Mr. Trump got elected, FIIs have been selling not only in India, foreign investors have been selling not only in India, but across all the emerging markets or even in the other markets, and taking their money back to the US capital markets. Our belief is that yes, this is a one time trade which has happened, but this cannot continue like for a long period of time. And as you can see in the next column out here, they have been net buyers in the debt markets, again because of our inclusion in so many global indices. So even if they were very negative on India as a country or anything of that sort, they wouldn't be putting nearly 2 lakh crores of money in the last 14 months in the debt markets. So please, look at it in from this perspective, that it's just a phase where they are reallocating their money from all the global markets as far as equity as an asset class is concerned to US as an equity markets or capital markets, but it's just probably a very short term kind of a thing. It's not that they will continue to do this. In fact, my sense is whatever they have bought in the last 14 months, if that has got sold, we are at the fag end of this sell off by the FIS coming to an end. And that market flows gives us a lot of confidence that they continue to be positive for a country like India. Right. So, this was something what we thought we will share with you as far as the macros are concerned, as far as what we believe the current environment is. I think we can now probably talk about how we have been navigating through these markets, what has been our investment philosophy, and how that is holding us steady during this, I would say, rough times. I wouldn't say they are difficult times, but these are rough times, at least in the last few weeks. So, we have been extremely disciplined for all the last 12, 13 years that we've been managing money, and at least for the time that I've been with MK Investment Managers. And these are few things that we, revolve around, and we don't go out of this. So we are very clear that we want to do only long-term investing. We believe in the game of compounding, and that's why we want to build our own conviction. We have patience not only after investing but also before investing. We are very focused portfolio. We generally don't have more than 20 odd stocks. 18 to 22 is our sweet spot. And the whole thought process is in investing, it's not about hitting a six, but it's just about avoiding mistakes. And to do that, it is very critical for all of this means that we have a very high quality portfolio. There has been not a single portfolio at any point in time in our funds, whether it's PMS or AIF, any of that, where there has been any compromise as far as the quality of the portfolio is concerned. And to have that quality of the portfolio, we have created our own proprietary modules. We have a lot of research discipline. Uh, One of that is our equal framework. And this is something that we created more than 12 or 13 years back. And this has steadied us very, very well over the last entire 12, 13 years. And even in the current environment, I would say. Because when I talk about quality portfolio, we have to understand quality of the every individual business flows from two sides. One is the management quality, and second is the business quality. And our entire fund management research team focus has been on this, that not a single stock in our portfolio where we would have any challenges as far as the management quality is concerned, as far as the corporate governance is concerned. So we have been very focused on businesses which have or managements which have high management integrity, management capability, wealth distribution to minority shareholders, investor communication to minority shareholders, and liquidity. Uh, Management integrity, and just to give you some glimpse of how this module works, management integrity is basically, what is the intent of the management towards the minority shareholders. And the thought process here is that investing is a game of probability. Keep on reducing your probability of going wrong, and you will reach your goal. If you look at some of the parameters that we work around to evaluate management integrity, one of them is, of course, the promoter holding. Uh, the higher the skin in the game, lower the probability that the management will do something silly with the minority shareholders. Has the promoter been increasing or decreasing their stake? That helps us to understand what has been their confidence. Because we've had quite a few of our portfolio companies where the managements of the companies have been increasing their stake over the last 24 months, and that has helped us understand that the confidence of the management in their own business is it's a good vote of confidence by them. Uh, Equity history, too much of dilution of equity, we don't appreciate that. So equity history is something also that we are very focused about. Promoter group salary as a percentage of profits, again, if significantly higher, we believe that's a compromise of minority shareholders interest, so we would like to avoid that. Even royalty in case of multinational companies, these are some of the very important parameters that we are very focused upon. We also have quite a few other red flag parameters. So, like if a debt equity is more than 2.5 times, we don't want to take any undue risk. for our investors, where we are the trustees and we have the fiduciary responsibility of not taking any undue risk and managing money with a lot of prudence. So, wherever companies where promoter holding pledge is more than 70%, we want to avoid those businesses, because in the last, I would say, more than a decade, from the days of Satyam to as recent as many other companies where promoter holding pledging has been more than 70%, there has been a compromise of minority shareholders' interest. Debt restructuring done more than once shows the weakness of the business model. We want to avoid those businesses. Uh, if there's a large acquisition, what is a large acquisition? Whichever thing is, whatever they have acquired is more than 50% of your balance sheet size, and we avoid investing in those companies for at least 1 year. After 1 year, we are very happy to evaluate where are we headed. Is the acquisition creative? Is it going in the right direction? We are more than happy to invest at that point in time. But again, the same thought process here. Better be safe than sorry, avoiding mistakes, right? So this is something what has really helped us in identifying compounding businesses in our portfolio. And as we move ahead the next few slides, I will showcase you the kind of the compounders that we have established in our portfolio and that we continue to own even today, and what kind of multiplier returns that they've given us. Right. So I spoke about the management quality, but also the business quality is of a lot of importance, and that is where we are extremely focused, obviously, on the track record. And when it comes to track record, we not only look at the P&L, but we are also very focused on the cash flows. We are focused on the balance sheet, and then of course the P&L. Cash flows is something because it's very difficult to manipulate those business cash flows. Balance sheet, because it's a cumulative of all these years. Every business goes through a good and a bad cycle, and how it got maneuvered during the difficult times is reflected in the balance sheet. And of course, P&L helps us understand the common size across the peer group comparison, to understand the cost efficiency that this business has, to understand the pricing power that this business has, as compared to the competitive landscape. So that is something what we are very focused about. We are also very focused about the business scalability, because Indian economy is all about growth. Indian stock markets respect the most where there is growth, and that is something what is a function of the kind of the business or the industry opportunity that this business is operating in. Sometimes it's also a function of how consolidated the industry is already. Is it already a 2-3 player market, or is there a large unorganized market, which is where the transformation is happening from an unorganized to organized? So this kind of the longevity of the growth is something what is very critical to us when we are investing for compounding businesses. The third, and again very critical, inherent profitability. We all want growth, as I mentioned earlier, but for higher growth, we need to invest more. The more we invest, the higher the growth in most of the businesses. There are few businesses where the investments and growth are not linearly uh, linked, but in many of the businesses, I would say investment in that business and the growth in that business are fairly linearly linked. Now, for that investments, if the investments are coming from internal accruals, if the businesses are coming from the cash flow that are generated from the existing businesses, I think that is a very high quality inherent growth that we are looking forward to. That is something that we are extremely focused about. So every ROC, ROE is not only the inherent profitability, but to our mind, this is the fuel to the future growth. That is something how we perceive the ROC and ROEs for every business. Management, we already spoke about in terms of their integrity, in terms of their quality. I think what is also critical is in terms of their execution, right? And also their strategy. So, we don't want, because every management needs to have that big vision. And of course, they need to have that, I would say, that detailing, that energy to executing it to the team, right? And of course, then purchase price. Everything is good at a price, everything is bad at a price. There have been many businesses that we have been evaluating for years and years, but we couldn't just invest because the valuations were not available at the right, the stock prices were not available at the right valuations. So we waited, and then over a period of time, because of the volatility in the markets, because of sometimes cyclical challenges with the businesses, but structurally the business continues to be strong. And with that insight, we have had opportunities to invest in high quality businesses, blue chip businesses, businesses with high growth, which is where our compounders have come into play, right? Coming to our capital builder strategy, over the last 18 months, we have been moving our weightages, I would say our portfolio construct more towards the large cap. We were probably just about 55% large cap nearly 15 or 18 months back. And over these last 12 to 15 months, we have been very gradually moving towards the large caps, and today, more than 72% of our portfolio is into large caps. And this is a function of, again, as I mentioned, it's a purchase price discipline. Wherever valuations were getting a little off as far as mid caps and small caps were concerned, we kept on exiting some of those businesses and invested more in large caps. And we continue to feel very comfortable with each of these businesses that we have invested in. Uh, the weights that you are seeing in terms of some of the stock holdings is not what we allocated. I just wanted to clarify that. These are weights that have become by default because of last 5, 7, 10 years of compounding in each of these businesses, and couple of stocks doing exceedingly well in the last, I would say, 24 months. Now, we have to understand that for new investors, the weights are not going to be this weights we have to showcase to you as a TWRR as per the SEBI norms. But for new investors, generally we have very strong allocation disciplines. The name of the businesses remains same, but the allocation disciplines are there. No single stock will be more than 7.5 to 10% if it's large cap, not more than 5 to 7.5% if it's mid cap, and not more than 2.5 to 5% if it is small cap. So companies like DVs, we are allocating in the range of 5 to 7.5%. Zomato, we are allocating only 5% at this point in time. ICICI Bank and HDFC Bank, we believe the current valuations are one of the most attractive. They offer the best risk reward at this point in time in probably today. And that's why we are allocating virtually 10% to HDFC Bank and ICICI Bank, nearly 7.5%. Sun Pharma at the current valuations where we are allocating nearly 5%. So we have this allocation discipline in place. Our portfolios are extremely liquid. As you can see, the average market cap is upwards of 3 lakh, and the more than 72% of the portfolio is large cap. Now, this is a slide which I wanted to showcase to you guys in terms of the compounding effect that we bring to the portfolio. There are so many stocks that we've been owning it for now nearly 5 to 10 years, and we've allowed them to compound. And that is something what is one of the unique, I would say, strength of our team, where we understand the businesses. We have so much of insight in each of these businesses and the management quality that we are able to, stick with them during the difficult times, because every business goes through a good and a bad cycle. But it is during those bad cycles, our research, our understanding, our insight, our conviction in each of these businesses and management comes into play and helps us decide that these are not structural issues, these are just cyclical issues. And as soon as these headwinds are down, and whenever there are tailwinds, these businesses have emerged very strong. They have remained resilient and they have emerged even stronger. That's why you can see that nearly 40% of our portfolio is now more than 10 years plus vintage. The next 35% is also now 5 to 7 or maybe 5 to 10 years. So which is almost like three-fourths of our portfolio, 75% of our portfolio has a vintage life of anywhere between 7 to 10 years. That is something what is very unique about us. And that's why we are very positive on some of these businesses even today. And of course, every quarter, every 6 months, there are new businesses that we always keep on, because there are so many of these businesses that we keep on tracking. And whenever we get reasonable valuations, we try to make room for them in our portfolio. These are some of the returns that we just thought we'll showcase to you in the last. This is as on 31st of Jan, as recent as less than 2 weeks back. As you can see, over the last 1 year, we've delivered nearly 18% returns versus benchmark at under 10%. Even over the last 3 years, we've delivered 19%. 5 years, we've delivered 19% compounded, and over the last 12 years, this portfolio has a track record of nearly 12 years. As on 31st March 25, we will complete 12 years. Uh, this portfolio has delivered nearly 6.3 times money to the investors. 100 rupee has become 630, effectively 530% of returns, 17% compounded over the last 12 years. Uh, Again, very similar, even if you have to benchmark it to most of the indices, whether it's Nifty 50, Nifty 500, Nifty 500 TRI, BSE 500 TRI, we have been outperforming across last 1 year, 2 year, 3 years, and also since inception. Just some benchmarking that we've done, some relative benchmarking to the industry peers. So we have ranked practically we have been ranking in the first quartile, in the top quartile for most of these periods: 1 year, 2 year, 3 year, and 5 year. We've delivered very consistent returns. As you can see here, our returns versus the mutual fund category average for the flexi cap, the median, also for the large cap, both average and the median, and what are the benchmarks. And our ranking has been in the practically in the quartile, first top quartile for each of these periods. Uh, these are just returns, but I think also important is what is the risk that we take? What are the risk adjusted returns? So as I mentioned earlier, that we are extremely conscious. This is, for our as money managers, we have a fiduciary responsibility. We are very very prudent about the risk that we manage, and this also is reflected in some of the ratios that you can see here. Some of the risk adjusted ratios, whether it is Jensen's, whether it is beta, whether it is sharp, whether it is start deviation, whether it is trainers, across the board, our ratios are far superior to most of the, I would say, the average category averages, right? So this is something what we just thought we'll share with you guys. Uh, Also, if you see compared to the flexi cap, the median, and me, so across the board, I think we have been very our beta is actually significantly lower, and also our standard deviations have been much better compared to the peer group. Also, some comparison with I would say similar PMSs, and again we have showcased to you here in the last 1 month, 3 months, 6 months, 1 year, 2 year, 3 year, and 5 year, all the periods, how consistently we have been, doing reasonably decent, I would say, or better than most of the other PMSs. And I can promise you, if you look at the risk-adjusted returns, if you look at the post-tax returns, we would actually come out with even more flying colors. So I just thought that this is something what we would like to share with you. But happy to make this the this event much more interactive. That's why we've left enough time for all of us to talk about and discuss and deliberate on whatever the current situation is. Rahul, over to you.
Yeah, thanks, Sachin. I think very, very insightful. I think that was expected from you. I think nicely explained. Specifically, if I have to just recap shortly some of the data points regarding the bond market involvement, how it has evolved. I think the depreciation of the rupee over a period of time, how the percentage has actually gone down, right? Inflation being under control, and that's why you look at India growth story moving ahead of China. I think it makes a lot of sense to still look at India for a long, long length of time. Plus, as you rightly mentioned, investing is all about avoiding mistakes. That's what I think the equal model definitely helps us to a large extent. I think that model itself talks about understanding management quality, which ideally is a subjective matter, but I think we have been able to put it in a way that we are quantifying it and making sure that we're looking at very, very good quality businesses. So that's amazingly explained. And plus, lastly, the capital builder consistency, I think, versus mutual funds, as you rightly mentioned, being in quartile one for the last 5 years with a lower risk, I think just talks about a very, very consistent portfolio performance. I think what I'll do is I already have a couple of questions. I will still mention to all the participants. If you have any questions, please put it in the Q&A box so that we can try and answer them as much as possible. And I was expecting this one question for sure in the current market. So you're talking about dollar depreciation. A simple question: do you still feel that there would be more depreciation going ahead on dollar?
Yeah, I think I've kind of partly addressed that point in our presentation, but to elaborate a little bit even more. So, we have to understand one thing that rupee depreciation will happen. That has been happening for the last decades, as far as we are concerned, because of our fiscal deficit, because of our inflation, because of our interest rate differential. We are a developing country. We need to invest much more. Dollar continues to be the world's reserve currency, so they have that advantage, at least at this point in time. But we have to understand, as I showed in the presentation, that the rupee depreciation has slowed down significantly. What used to be more than 5 to 6%. In fact, if you see from 2009 to 2014, the first the 5 years with the rupee depreciation was 6%, 6.3% annually compounded. That has
Right.
slowed down to as low as 3% over the last 10 years. In fact, even the calendar year 24, we were under 3%. We were at 2.8%, and which was much better than most of the other global currencies, right? So I think, and even in the current environment, we have seen. So I think the way to look at it is, what is the rupee depreciation we expect over the next 3 to 5 years? And my personal feel is, and where I'm coming from is that the spreads between the 10-year US Treasury and the 10-year India GSEC has now that they have narrowed to under 2.5%. Uh, and this has been there for now almost 18 to 24 months. It's not a 1 week phenomena. So this is getting established, with the two best category of bonds that you can think for two of these countries. So from that perspective, I think the next 3 to 4 years, the rupee depreciation probably will slow down even further into the range of just about 2.5%. So what was
Thanks.
6.3 to 3.5 to 2.8, probably now to just about 2.5% for the next 3 to 5 years.
Sure, I think that addresses the question nicely. One more important thing, in the current scenario, would you look at allocating the money in an STP mode? And more importantly, if the money is lying in debt, would you want to move that money towards equity, regularly, or maybe buy lump sum in that case?
Yeah, that's a great question. So I would say two, three things, because the question is embedded part of two, three scenarios. So clearly, first very important thing is asset allocation has to be a very disciplined approach, right? So if you have already decided, depending on the profile of every investor, an asset allocation plan has to be in place. What percentage of money of your wealth, or what percentage of your wealth has to be in fixed income? What percentage of your wealth has to be in equities? What percentage of your wealth has to be in some of the other asset classes, whether it's precious metals or whether it's real estate, depending on what are your requirements, what are your needs, what's your profile, right? Uh, if in the current meltdown of the equities, if those ratios have moved, for example, if you believe that or if your current allocation in equities is say 70%, and you already had that 70% say in the by December 24, and today, because of the meltdown in the last 45 days, if that equity allocation has probably come down to 65%, right? Then I think it's fair to move 5% from your debt or your other asset classes to equities. That's the very first point. Second, just generally, if you have to forget about asset allocation and somebody says, forget about that, I'll take care of that. But what's your general view on the equities from the current valuation? So my sense is that today, if you think about it, both Nifty and Sensex are probably trading at just about 20 times FY25, FY26, which to my mind are very reasonable valuations. Uh, And my sense is that a lot of large cap companies, quality businesses, like I mentioned a couple of names which are part of our portfolios, HDFC Bank, ICICI Bank, some of these companies offer extremely high risk reward, I would say, payouts. So I think there is clearly a time to start SIPs, if not a lump sum. But even if somebody wants to do a lump sum, I'm fairly confident that to make a decent double-digit returns over the next 3 years from current valuations, at least in the large cap indices, shouldn't be a big challenge.
Perfect. Thanks. I think one more question. I think you partly answered this, but if you just maybe spend a minute more on this, it asked about how do you think about FPIs increasing their allocations going forward in Indian markets, I
Yeah.
guess.
So again, that's why we anticipated a couple of these points, and that's why we created those slides. We've
Correct.
seen that whatever FPIs invested in the first 9 months of calendar year 24, they have more or less got sold out. I don't think there will be too much of aggressive selling from here on. That's point one. Point two, I think the current valuations, and as in when they start looking at investing outside US capital markets, India will definitely be on the top of the list, uh, particularly with our earnings growth, particularly with our young aspirational demography, particularly with our government balance sheet size or balance sheet discipline, particularly with our currency resilience. I think a lot of these factors are going to play out very significantly in the next 1 or 2 quarters, is what my belief and my confidence is.
Perfect. I think one couple of questions from Prabhat, in fact. What do you see the impact specifically from Trumponomics? So we're talking about Mr. Donald Trump on markets and what his views can change the markets or not, and the sluggish earnings growth on the market valuations which are there currently, specifically in the last quarter results.
Right. Yeah. Thanks for those questions. I think those are also important points at this in the current juncture. So, first talking with Mr. Donald Trump's policies and whatever announcements and some of the actions that they are taking, to my mind, they are going to cool off very quickly because at the end of the day, the global supply chains, they cannot be created overnight, right? There are very they take probably decades, okay, to get created, to create that kind of supply. It is a long gestation period. So even if they want to get less dependent, or they want to have some, I would say, difficult scenarios with the countries who are supplying them today, it's going to be a while for them to create alternate supply chains. That's one. Second, I think we have to understand that every business, every country has their own strengths, and it is because of those strengths and because of those I would say specialization, the world inflation and even particularly US inflation has remained very subdued over decades. And thanks to that, it has helped their purchasing power, it has helped their currency to remain strong. So I don't think there is going to be too much of action from here on. Whatever announcements that he had to make, all of that, is a good part of that will remain noise, and some part there will be actions, because some things which have got a bit adverse, which have gone out of proportion, they are trying to correct that. But beyond that, I think if they do that, it will hurt them much more, in at least in the near to medium term. So my belief is that they are smart enough, they are wise enough not to disrupt to a point where it starts hurting them much more than the others. So if our businesses have the domain expertise. They can deliver the scale. They have specialized in particular manufacturing processes, right? I think our businesses will hold the fort, and it's a collaboration. They need us, we need them, right? So I'm not overly worried. Let the wind of noises just pass, and so I think that should take care of a lot of things in the next 1 or 2 quarters. Uh, Coming to your second question, as far as the earnings growth slowdown is concerned, I think we have to understand one thing, that nothing goes up in a straight line, right? For the last 2 3 years, we've had a very strong earnings growth. There will be times when earnings growth will take a back seat, or there may be some bit of a pause, but that doesn't change the next 3 to 5 years of trends, right? Because we have to understand that India is a very strong consumption story. India will also be a very strong manufacturing story, as we discussed in some of the presentation slides. India will also be a very strong export story, right? So these are very three strong legs. And let me just elaborate a little bit more on this. When I talk about consumption, I think Indian economy has now transformed itself to being a consumerism economy, right? And when I talk about consumerism, uh, what I'm trying to say here is that because we have a young, aspirational population demography, this population is always going to consume much more and more and more, because they today their aspirations are touching the sky. And thanks to some of the, I would say, new age businesses, whether it's quick commerce, whether it is the Amazons and the Flipkarts of the world, the instant gratification that it gives them, okay, is has a very different level of consumption. So I am fairly confident that although India is always a two step forward and a one step backward story as far as consumption is concerned, because our purchasing power is not as strong as some of the developed countries, but over a period of time, if you take a 3 year, 5 year trend, this is a mega trend. So I'm not worried as far as the consumption growth is concerned in this country. Second, as far as the exports is concerned, I think our services exports continue to do exceedingly well. Even our manufacturing export, if you see in the current environment, we have continued to hold forth. And there are at least 6 or 7 industries, okay, whether it is contract research and manufacturing, whether it is specialty chemicals, electronics manufacturing, engineering, within engineering, hardcore engineering, uh, power equipment, also textiles, auto and auto ancillaries. So in this 7 to 8 industries, Indian companies have clearly established that they have the domain expertise, they can deliver the global scale, and they respect the intellectual property rights. So the global investors, the global purchase managers are queuing up at some of these companies, giving them orders, and they want them to execute significantly over the next 2 3 years. So I'm fairly confident as far as the export and also the manufacturing is concerned. So you know, slowdowns are always a part of the cycle, but structurally we continue to be on a very strong foundation. I think a growth of 12 to 15% earnings will still happen irrespective of anything in FY26. Can we accelerate that further to 15 to 18% in FY27? I think a high probability.
Yeah, couldn't agree more. I think all the three aspects working well for India. That moves on to the next one, specifically more on the banking side. What's your outlook on the banking stocks for the next 1 year per se? Specifically looking at interest rate cuts and maybe a lowering of NIMs going ahead.
I think you have to understand one thing. In banking, the business is very simple as long as bankers try to keep it simple. And I think the lessons have been learned very hard way in the year of 2000, probably 8 to 14 or something like that. And thanks to that, I think bankers are now keeping it very simple and straight. So the asset quality is of pristine quality today with most of the banks. Second, I think interest rates going up and down. Finally, it's a pass through for most of the banks with the lead and lag effect. That's all. So if you take a 3 year, 4 year, it all evens out. Nothing to worry on that. Uh, Third, I think today the valuations of some of the leaders, particularly in the private sector banking, have become very, very reasonable. I have not seen this kind of reasonable valuations for the last 10 or 15 years that I have been investing. And I think those valuations really offer a fantastic risk reward payout. And so, and to my mind, the growth, if somebody believes that the valuations are not attractive because the growth outlook is going to be dull. I don't agree with that because at a less than $3.5–4 trillion economy, we will grow at least 10 to 11% nominal GDP, 7% real GDP over the next 3 to 5 years. And it is the banking as a sector uh, is the backbone of any economic growth. And some of these large private sector banks, the leaders, they have a very strong consumer franchisee as far as the deposits are concerned. They have very strong internal processes as far as their asset quality lending is concerned. They have very strong, I would say, understanding of their profitability and maintaining those profitability, whether it's your ROAs or ROEs are of the concern. So they are today kind of, I would say, uh, self uh, they are self-generating machines. They have at least anywhere between 15 to 18% of ROEs, and their growth opportunity, because I spoke about the growth opportunity, the longevity of the growth is so good that they can easily redeploy this 15 to 18% of ROE that they generate every year. As I was talking about, these are fuel for growth, the inherent profitability for their the because the loan book growth, or the loan book growth, deposit growth, whatever you call it, will grow at least 12 to 14% over the next few years.
Yes, I think we have currently a last one, and this was again an expected one. Quick commerce companies, Zomato, Swiggy, I think being under pressure recently, more so maybe because of competition. How do you see this space evolving?
So when it comes to new age businesses, okay, let me put that as a category. I think one have to be. Let us first accept the fact that today the consumers, the customers are literally, have embraced these businesses, right? So we cannot ignore these businesses. Let's be very clear about that. Because wherever the consumer is there, and that too at such a large scale, when you have millions of people, not only understanding, accepting, but embracing, literally doing their transactions uh, in a daily routine life. I mean, new age businesses have probably become a part of our lifestyle today, right? Whether it is your food delivery, whether it is your shopping, whether it is your say courier services, whether it is your payments, for all of this, we are practically using new age businesses as our first choice, right? So I think let's first understand that we cannot ignore these businesses. In the same breath, what I would like to add is, yes, it is a good thing that the businesses, that the consumers have embraced this, but it is also important to establish that do these businesses have inherent profitability. And wherever this combination is there, I think it is worth having these businesses as part of our portfolio, because otherwise your portfolios will become irrelevant as we move ahead in this new age economy, right? So wherever businesses have inherent profitability, and wherever they have consumers queuing up to them, I think these are two amazing combinations. Wherever we have figured out, we have made them as a part of our portfolio. Coming to our current, uh, you know, uh, the current valuations of some of these new age businesses and stock prices that have got corrected, I think we will have to introspect a little. We'll have to deep dive a little bit more and see whether these businesses continue to have those moats, continue to have that inherent profitability, and these are just although and the businesses still do well because some of the businesses have not got impacted at all. They continue to grow at 20, 25, and some of them even at 100%. And if that business's profitability continues to remain, in the right direction, then I think the current price corrections, the stock price corrections, have to be uh, evaluated from an opportunity perspective rather than getting worried.
Thanks. I think these are, as you rightly mentioned, these are more habit formation businesses, new age businesses. We are getting more used to it. So yes, current fall might obviously be more of an opportunistic thing to look at, right? I think we are, yes, I don't, that was the last question. I think we'll conclude this call. I think thank you very much, Sachin, for your insights, for answering this questions patiently. We look forward to you, moving ahead for next quarter again. To all the participants, to all the clients, all the distribution partners, thank you very much for attending this. We'll come back to you for our next session very soon.
Thank you,
Thank you
everyone.
once.
Have a nice evening. Have a